We're going to be talking now about shaping the future of real estate. And I think I can see a few people coming on the line. I'd like to welcome Ali Mheiri, the Executive Director of Real Estate and Infrastructure at Mubadala. Richard Mack is the co-founder and CEO of Mack Real Estate Group. And Joseph Sitt is the Chairman and CEO of Thor Equities. Welcome, gentlemen. There we are. Welcome, everybody.
Thank you for having us.
Thank you guys so much for joining us. This is great. Well, you heard there His Excellency speaking essentially about what the future of investment is going to look like, where he's looking to put his money, things that look attractive from the healthcare perspective as well as real estate. So that's a good lead-in for what we want to talk about today. I wanted to quickly do a bit of a lightning round between all of our panelists and just take 2 minutes to walk me through how you see the next 6 to 12 months in terms of the real estate space. Ali, I'd like to start with you.
Thank you. Good evening, everyone, and good morning to the people in the US, and good evening to the people in Europe. I think the follow-on to what His Excellency Walid mentioned, to us, uncertainty plays a very big role in the next 6 to 12 months. We really don't know how the world and basically the real estate market is going to look post-COVID. As we have seen, as soon as the COVID hit, the hospitality sector got decimated and retail followed suit. Office and retail proved to be a bit resilient, but you can see the drop in the numbers of people coming to work, residential viewings, buying, transacting, etc. But I think what's going to be very interesting to see is how, in particular, the commercial space is going to react. I mean, I strongly believe that people will not only work from home, they will want to go back to the office. And I think that people or big corporations are going to continue to ask for commercial space, the same, if not more. But it's not due to the increased number of staff, but more of what we call extra elbow room. So people are going to pay more attention to their personal space in the offices from a social distancing perspective. Also, people are going to invest more in their homes, because staying locked up at home for a month or two made people realize that, you know, if I'm going to be locked up in a place, I need to make sure that it's comfortable for whatever happens in the future. So my view is that people also going to invest more in their homes, either getting a bigger space or making it more, I wouldn't say future-proof, but make it more comfortable should they be required to stay weeks at home. That's my view.
Richard, weigh in on this one. What's your prediction for the next 6 to 12 months?
Well, look, I think none of us really know. I think that we're all trying to figure out what's going to happen. But what I will say is that nothing that we're seeing is really new. And I view what has occurred as just an acceleration. We had too much retail space before, especially in the US. I like to say, and Joe may have a different view, that, you know, retail has been under demolished in the US. We had too much hotel, and we still have too much hotel. We probably had too much office, and we had this oversupply in part because of the changing demands created by technology and by just changing patterns of living. So whether it's e-commerce or blockchain technology or telecommuting that we're doing now, all these things have been disrupting real estate, but the pace has been very, very slow. And so what we are seeing is all the things that we were worried about before are going to happen faster. And so we need to adjust to a new world. And what you've seen in the markets is that the markets are telling you that office space is never coming back. Well, I don't necessarily agree with that. It depends on which stocks you look at. That telecommunications in terms of data centers and cell towers are really the only place to invest. And so the market is overreacting as you look at the stock market to everything, to the acceleration of all these trends. But yet the private sector, we don't see assets trading at a big discount yet. And so the next 6 months is going to see whether or not the private market has it right, where things are not trading at a big discount or not trading at all, or the public markets where securities are demonstrating price discovery for every asset class has it right, or is it someplace in between? So I just see it as an accelerator, and that we're going to learn which is right, the public sector or the private sector, over the next 6 months.
Joe, what is your crystal ball telling you?
Thank you. Well, 3 months ago, I participated in the panel of the panel, meaning Milken Institute. Had the team get me on the telephone, and while the world was looking kind of bleak, I was relatively bullish in certain sectors or investment scenarios, and bearish in others. And bifocal view in terms of the stock market was extremely bullish, and 2 reasons. Number one, as I said, was the fact that the government spending that was going on was, unlike the last Great Recession, here this time wasn't just lending money out effectively that can be pulled back in, was actually pushing capital out all the way down to the hands of potentially consumers, and would be the kind of money that can be put back into a genie bottle at any point in the future. Now, the ending results of that might have negative consequences, which I won't comment on, but I would say that made me bullish about at least the short and medium term prospects. Number 2, I said this was going to be the great accelerator. They kept calling it a couple of months ago, Great Recession, Great Financial Recession, GF2 they were calling it, and GFR2. And I said, no, you're wrong. This is the Great Acceleration 1. And my comment was that it would be the separation of the big boys and the little boys, big boys and the big girls and little girls, and that in every single sector of the economy, you would see the most dramatic acceleration of all the disruptors that we saw happening before, now effectively moving its pace and schedule from 5 to 10 years from today to 2 years from today. And if you stop and think about it for a minute, the migration in the movie business to streaming, the migration in food business to cloud kitchen, the migration in retail to e-commerce, the migration in energy over to green tech, the migration of fashion over to athleisure, the migration of cloud computing, and you can just go on and on with the examples. The one rare example are things that by their nature are communal oriented. So anything having to do with gatherings, people in tighter quarters like a downtown, and last but not least, travel is the one group of trends that were moving that didn't get accelerated, that got halted. But in my opinion, they'll be temporarily halted. So from that perspective, I'm bullish, but I'm only bullish about those trends that were moving that got accelerated. Even food itself. I mean, for the first time, when they were running out of meat here in the United States, I was eating Beyond Burger hamburgers, technology company hamburgers. So overall bullish, so long as the government and the government in Europe, et cetera, continue to support the economy the way they have. And again, dangerous ripple effects, but I won't cover that part today.
Ali, I want you to pick up on something that Joe just mentioned in terms of the hospitality and tourism. Obviously, the UAE has just decided to open up Dubai to tourists. They'll be coming in just a few days from now. Dubai, of course, a major tourism destination. Pre-COVID, a transportation hub internationally that was second to none. With the largest, I think, passenger traffic of any airport, frankly, in the world in terms of those through passengers. How quickly do you see the tourism sector turning around at this point, given the surge that we've seen of COVID-19 once again in the United States?
I think it will depend on the consumer confidence in actually getting on a plane and coming to the UAE. And this is mainly for the people that are outside in the UAE. People are still nervous in terms of what's the experience of getting into an airport and from there getting into a plane. How will people pick up the virus in the airplane or in the airport, etc. So the first step is actually getting the people confident that it's okay to fly. I mean, if you look at the 9/11, there was some time where people just said, we're not going to fly. But then that ramped up very quickly. I think 2 to 3 months, people were back in the air as normal. So I think the first step is getting the people confident in doing that. But when you look at the tourism in the UAE, there's a lot of, currently the UAE has a population close to 8 million. And people are actually going to explore of what we call staycation in the UAE. as soon as the social distancing has been easing up, a lot of hotels in the UAE have ramped up in terms of reservations for people staying on weekends, especially now that school is over and summer's there. We have seen numbers of people going to those hotels because they have been cooped up for, I would say, 4 to 6 weeks into their houses. So to me, the UAE tourism sector will recover because the government has taken strong initiatives to make sure that people feel secure, whether they're staying in hotels or resorts, that yes, it is safe, it is clean, people are paying a lot of attention to the very strict guidelines that the hospitality industry is following. So that will recover. However, it's subject to people getting comfortable jumping on a plane and coming to the UAE. And that's, I think, what the airlines mainly will need to focus on in getting the passenger confidence jumping into a plane.
When we think about this a bit more broadly, Richard, I want to go to you now in terms of thinking about this within the lending space. I mean, when we think about the global financial crisis, that really did expose, frankly, the ratings agencies as well as the banks in terms of what they were willing to take on in terms of loans. This crisis arguably has, discovered even more so the holes in the lending system with regards to REITs and other things. What's the most concerning thing that you've seen play out over the last few months with regards to the lending space for real estate?
Well, the lending space for real estate has been in a state of transition since the great financial crisis. And with the implementation of Dodd-Frank and Basel III, what we have seen is the emergence of alternative lenders. And unfortunately, most alternative lenders are pretty highly levered themselves. And this creates a lot of volatility in their capacity to buoy the market in times like this. So a lot of the alternative lenders have seen themselves have capital calls and don't have dry powder to help this market come back. And even my business, when I think we're pretty well capitalized, we're sitting on quite a bit of dry powder and liquidity, we've just stopped lending to wait and see where things settle. But I can tell you that there are people like us who are not banks and are not scared and can evaluate risk and reward. And we have been quoting loans. We've quoted 3 loans in the last 2 weeks, and we're ready to step back into the breach. Now, it's a little bit of a dangerous game. We can be catching a falling knife. But as a lender who is set up inside of an owner, operator, developer, we're prepared to take a little bit more risk. And so we are looking at this and saying, how much worse can it be? And so if we are lending at 60% of what we see as post-COVID values, we're stepping up and saying that we don't think that the valuations are going to drop here. Let's say drop 20 or 30%, another 40% from here. And therefore, in an environment where very few people want to step up and lend, we're going to do so. And I'm hopeful that we'll see capital formation away from the banks in other alternative lenders, because the returns that we can get per attribution of risk are much better than they were, significantly better than they were pre-COVID, because we have very little competition. Our competition before was other alternative lenders like us and some banks that were willing to be a little bit more aggressive. The banks are really out of the market, and a lot of our competitors don't have the capital to step back in. Part of what we're all going to face is if we don't get more liquidity into the lending sector, is the valuations will drop more steeply than we had anticipated. So it's important to try to get capital into the lending sector, and we think it's a great opportunity as well.
Joe, where do you see the ability to strike the right balance at this point?
I'm sorry, the communication.
How do you see the ability to strike the right balance at this point?
In terms of?
And with regards to lending and the market, because the government's done actually all the government's going to do.
I'm more on the borrower side as opposed to Richard. And I will tell you that obviously capital markets are extremely constrained, but still much looser than they were only 3 months ago. And I think that as a result of the tightness of the marketplace, it's slowing the transaction volume. That's why you don't see the movement of capital. The other reason why I don't see the movement of capital or transactions happening, candidly, is the friendliness that the current lenders are having to have to their borrowers. They know that they don't want to foreclose on these assets. You know, you've had assets that have gone up in tremendous value that have had overnight poof, the value disappear because of tenants blowing out of those locations. And I think the smartest lenders have been patient with those borrowers, trying to help them work through their difficult times to try to get them together with themselves to the other side. I am hopeful that the lending markets and capital markets are a little looser, but I think that's going to be further down the road, my look.
In terms of that, and specifically how we pull the global economy back from the brink, obviously governments have been scrambling and to do as much as they possibly can via policy, but obviously you can't legislate growth. When you think about what's happening in the United States specifically, are they getting it right, at least so far, or is it just too soon to tell, Joe?
I think that they've been making the right moves. And you see it even in the result in terms of business. We manage capital for some of the largest global institutions in the world. And one of the most interesting conversations I've been having lately or hearing from investors have been telling us, you know, we want to invest now where the politics is friendly to business, meaning red states. I mean, I was shocked to see it, but I had two different large institutions, both of them from quote unquote blue states or democratic states, that told us we're leaning towards, and in one case only interested in investing in cities or states that are red states, pro-business and lower taxes.
Times how have they have changed.
Yes. So it was a fascinating experience just hearing that from the folks that I was hearing that from. So people are paying attention to the politics where there's pro-business, and to be candid, people are afraid of the big red cities. People are afraid of New York, Chicago, all the markets that have built up big deficit spending and have the bigger taxes. And you see the migration and movements of people. That's part of why your hometown, Tennessee, is starting to get so popular nowadays, and receiving so many New Yorkers, as well as Texas and Florida, et cetera, et cetera.
That doesn't surprise me one bit. I want to ask Ollie now to weigh in on this, but make it a bit more global, Ollie, when you think about the geopolitics and frankly, what's happening even in this region as well. Where are the attractive regions for you as an investor?
I think if you don't mind, I'll just comment on what Richard just mentioned earlier about the lending. For us, being a sovereign wealth fund, you know, we have the advantage of being patient capital. So for us, we're not a fund. We don't have a fixed term to invest in, and we need to get our capital up. So for us, we view ourselves as patient capital. And we're both in our investments, we're either a borrower through our equity investments, but also sometimes we're a lender. So we try to come up with the various capital structure, whether we're MS or prep or even just below senior lending. And I agree with Richard's approach where everyone has dry powder with them right now. But the question is finding the right time to enter into a market, because everyone's fearing that they're catching a falling knife. But at the same time, all the players cannot just sit on the bench and watch, because unless people do their part in any economy, the valuation is just going to spin out of control, and the values are going to come down, and then everyone will lose. So for us, we're watching all markets very, very carefully and trying to enter either from a lending side or from a borrowing side. Our strategy has always been focusing on gateway cities in the big markets. As Walid mentioned, the US is still a very big market for us. I believe on the real estate side, it consists close to 30 to 40% of our capital deployment, followed closely by Western Europe. And also in Asia, we have some investments in China and some investments in Japan. But these are all depending on gateway cities, but more importantly, with the right-minded partners into those cities. So for us, we're a global investor and we follow opportunity wherever it is, but we always do it with partners in those key markets.
If I can add Hadley, just another comment about government incentives. You know, as a company, we're focused almost exclusively on the two L's, laboratories and logistics, for a number of years now. But prior, we were big retail investors and still have some legacy assets. And I've been talking to a few of those tenants because some of the retail tenants are coming for help, deferment, forbearances. I'll tell you, I don't know whether the right word is a dirty little secret or just a secret, but I would say that the most shocking thing that people are going to see come only about another 2 weeks from today, when the retailers report, Richard, I would say are the highest comp store sales increases in the history of the retail business since I've been watching it in the last 30 years as a result of the capital that the government's putting out. I would bet you, you know, in a normal month or couple of months, normally you look for comp store sales for the quarter, you know, hoping for 3%, 5% is fantastic, 8%, 9% is, oh my God. I think that you're going to be shocked to see that the comp store sales in the United States, at least for retailers, are going to report somewhere in the neighborhood of 30 to 80% comp store sales increases, as shocking as that is to hear. And that's as a result of all the capital that the government's putting out. Now that money supposedly runs out, some of those extra unemployment benefits at the end of July, they're talking about extending them, but just talking about government incentives, I think it's going to blow everybody's minds away in only a couple of weeks from today. Revenge spending.
Do you buy that? Do you buy that, Rich?
You know, I buy that spending is up, but you know, spending is up from a low, and so I'm not sure what the comp store means anything. Forgive me, Joe, for saying that.
Comp store to last year when there was
comp store to last year. Okay,
no pandemic at all.
But still, it's because a lot of it's pent up. So I'm not as bullish. I think that retail as a business and as part of the real estate business needs to be fundamentally restructured. We have too many retailers on life support. I understand that you know, there's a deal, few real estate people to buy JCPenney, for example. I don't think that's really a good idea. I just think that that continues to delay a problem that we need to face. And if things are going to get accelerated, we need far fewer malls, we need far fewer retailers, we need better malls, we need better retailers, and we need better delivery systems and competition for Amazon. That's where we're headed. So I'm not, you know, by the way, I have zero retail in my lending book. So that maybe tells you how I've felt about retail for a long time. And that's because I have economic exposure to retail elsewhere in my portfolio. But so I'm not really buying that. I want to just jump on something that Ali said about gateway cities. And those have been the best places to invest historically. But part of what we're seeing from this acceleration of trends is that we're seeing the rise of the other cities. We're seeing the rise of some suburban attachments to gateway cities. This is part of the red state, blue state. This is part of telecommunications. This is part of millennials who want to stay in cities but be in smaller cities as opposed to being in suburbs. So a lot of trends that existed pre-COVID are getting accelerated, including ones that are a bit negative to gateway cities. I don't think gateway cities are going away at all. I just think we're going to see the rise of other nodes of urbanization, and that's where I think things are going. Just to comment on that point that was made.
Ali, I wanted to follow up with that as well in terms of the gateway cities. I mean, is there a plan already to move away from those traditional gateway city investments or to reallocate? I mean, what's the strategy?
I think for us, you know, gateway cities are always going to be a primary, but again, it's about opportunities. Just like Richard said, you know, if people move out, if certain cities that are attached to those gateway cities are where the growth is going, where your customers are, where the opportunities are, we're always going to go there. So we're not going to shift 100% out of the gateway, but over time, I think we're going to start to look at those. Also, there are other places historically pre-COVID we wouldn't take a look at, but post-COVID, new sectors being set up, new geographies are starting to pop up where there's tremendous value, but you have to go there carefully. So we're actually looking at those.
I would also agree with what Richard said. I think that, from ourselves, we actually view ourselves as three strategies: laboratories, logistics, and Sunbelt investing. And we think it's where it all comes together: the growth in those marketplace, the good weather, and the good, business friendly or economic friendly lower tax policies. And so, yes, we've been and have been now a decade migrating to the Tennessees, the Texases, the Floridas, the Colorados, and the Arizonas, et cetera, et cetera. And even as he mentioned, even looking at suburbia from the big cities ourselves, we either closed on and or we're in contract to purchase 1.9 million square feet of laboratory space in the state of New Jersey, just outside New York City. We had the choice to look at a couple of opportunities to do redevelopments in New York proper or do them outside, whether it's in Bergen County or Jersey City, et cetera, et cetera. And we chose to go into the more suburban markets and more suburban areas. Do I think it's the end of the cities? No. Myself, I'm a city dweller. I still think live, work, and play will be a popular thing. I think people are going to wait a little bit, be a little more hesitant, but once those restaurants open back up and some of the entertainment and the theater, I think it'll slowly bring people back. I think just short term, people are afraid, and it's not just the corona. The other topic obviously is the protest. Put a lot of fear in folks. If you visited New York City only 2 weeks ago, like I did, or a week and a half ago, I was there that Monday and watching everybody boarding up the stores, et cetera, et cetera. It looked like Iraq after an incident came through. It was that scary. But now you come back to New York City this Monday night. I was out at Cipriani restaurant in Soho, and the place was rocking and people were outdoors and everybody was happy. So I think in time, Richard liked that one, I think in time we'll be bringing the people back and some friendliness, but it's definitely going to be a little bit different in terms of the distribution of where people's favorite places. And so I agree with Richard. Sunbelt will continue to have that momentum.
Hadley, if I might connect something that Ali and Joe have said around hospitality and tourism and the gateway cities. Hospitality and tourism will come back, but we're going to need either herd immunity or a vaccine. Once we have that, both the gateway cities and hospitality and travel for leisure will come back, and it'll come back strong, and people will forget. However, I do think that business travel is going to be significantly reduced, and I think that that is a trend that we really can't do much about. So
we're going to be doing these Milken Zoom series for a few years to come, do you think?
We probably will, and they're going to get better, and we're going to get better at them, and that's, I think, the future. But nothing can replace working together in offices, but maybe people will be there a little bit less. Nothing can replace person-to-person contact, but maybe once we've established good rapport, we can do more of this. So these things are kind of all connected, and it's going to take a while to play out. But I do believe we will get back to normal. But as we've been saying, it's going to be a new normal.
I was talking to an architect friend of mine. His name is Rem Koolhaus, and extremely bright, extremely talented. And he said it right. He said that certain places where the want is versus the need is going to have to be evaluated. What he meant by that is leisure travel is a want. And so people get over the travel phobia faster. You mentioned beforehand yourself, Hadley, how you want and heading to Turkey. We're one of the largest developers in Mexico. We have one of the assets we have is the Montage Hotel in Cabo. I will tell you, the bookings bounce back is incredible. So you see that pent up demand. But yet on the other side, if I gave the negative, I think the eye of the storm probably in real estate is probably convention hotels. I mean, just the fact that this is working out so well, I hate to say it, we're an owner of just one of them, but there's going to be a lot less need for that type of gatherings. It'll be more the want gatherings, like maybe a Milken event where I'm getting to meet new and interesting people, not just the same people from a particular industry that's gathering together where I've already met them before and I could communicate through Zoom or whatever methodology there is. So, so I think it's going to be binary in terms of the need, the want, and the needs of locations.
We're already seeing that playing out in many ways in the corporate bond market. I mean, how likely would it be that any of you gentlemen would feel the urge to go to Vegas and spend some time in the casino at this point?
And so well said. In fact, it's funny you said that. Yesterday I was talking to somebody who does this annual migration about this time of year to Vegas. For whatever reason, they're Vegas addicts. I said, where are you going? And he said, well, I booked 2 years to travel the Midwest. I said, you going back to Vegas now? He said, no, I booked Colorado. I'm going to Aspen, Colorado this year and next year. I said, Aspen's alive and well.
They're doing quite well at the moment, everything I've read.
Exactly. So
everybody wants to be in the green.
Exactly. It'll be interesting to see how the world opens up when everybody goes from being home, maybe playing on their Robinhood account, trading stocks, sports opening up, et cetera, et cetera. It'll be different. We'll see if we're still in a DraftKings and a Robinhood world, or whether we're back to a little bit out and touch and feel world.
Gentlemen, I'm afraid we're going to have to leave it there as we are out of time. But thank you once again for joining the Milken Institute Summer Series and CNBC International as well. Have a great evening.
Thank you.
Thank you. Thanks for having us. Thanks.
Thank you.